Hey guys, you know what's even better than a stock that pays dividends? A stock that grows those dividends year after year. And what's even better than that? A stock that grows dividends by a double-digit percentage every year, 10% or 15% or 20% or more. Which leads me to this. If only there was a high-quality company that grew its dividends by triple digits. Wouldn't that be awesome? Well, yes, it would be, and it is. I just bought a bunch of shares of this 100% dividend grower for myself, and I liked it so much that I selected it for the latest $1,000 buy for our Income Builder portfolio. Hi everybody, I'm Mike Nadell, here for the Dividends and Income channel. Hey, do me a favor to help us grow our channel, will ya? Pop the thumbs up at the bottom of the video, subscribe to our channel, and ring the bell so you get notifications of new videos as we publish them. Now, before I talk about this fantastic stock that just doubled its dividend, I want to take a second to update you on the Income Builder portfolio. I've been picking stocks twice a month for the IBP since 2018 and writing articles about the process. The co-founder of this channel, Greg Patrick, allocates $2,000 every month for the two buys. The IBP's main goal is to build a reliable growing income stream, and the secondary goal is to experience competitive total return. I firmly believe doing both is possible. We also have a long-term income target to build a $5,000 income stream in 7 years' time. The IBP now has 43 stocks. It's worth around $120,000, and it's generating just about $3,000 in annual dividend income. Greg and I aren't suggesting that anybody replicate this portfolio. No, we do this to get folks talking about portfolio building concepts, also to present interesting investing candidates for our fellow investors to research thoroughly for themselves. I'm always updating the portfolio's homepage on our website, so if you'd like to learn even more, make sure you check out the IBP link in the description. Okay, so now let's talk about our latest buy. Wall Street investment bank Morgan Stanley, symbol MS. Here's the buy we made for the IBP on July 12th, getting 11 shares at $92.85 a piece. You might have noticed that the order was executed in two separate transactions, one for 10 shares, the other for a single share. That sometimes happens with limit orders. It's all good. Now let's talk about that amazing 100% dividend hike. Morgan Stanley had kept its quarterly dividend frozen at 35 cents a share because the Federal Reserve had told banks not to raise dividends during the COVID-19 pandemic. But Morgan and other financial institutions raised their dividends after they had passed the Fed's stress test, which indicated that the banks were well above the minimum capital levels required to get them through a hypothetical severe downturn. In doubling its dividend to 70 cents a quarter, or $2.80 on an annual basis, Morgan Stanley also doubled its yield to an appealing 3%. As a bonus, Morgan Stanley also announced a $12 billion stock buyback plan. Generally speaking, when a company's share count is reduced with buybacks, the remaining shares are potentially more valuable, as each shareholder will have a higher percentage of ownership in the company. Like many of its rivals, Morgan Stanley was forced to cut its dividend during the Great Recession, and it wasn't until 2014 that the dividend started growing again. But the annual dividend has grown from 20 cents a share to the current $2.80 in only 7 years' time. That's some aggressive dividend growth. If you own Morgan Stanley before the July 29th ex-dividend date, you'll get the first deliciously double dividend. We bought our shares before that date, so on August 13th, the IBP's 11 share position will generate $7.70. That will be reinvested right back into Morgan Stanley shares, a process known as dripping. We do that with all 43 positions, and it's an effective, organic way to build an income stream. Over the next 12 months, Morgan Stanley will bring in about $31 into the IBP. The dividend isn't the only thing that's been growing for Morgan Stanley, which has had a robust recovery since the darkest days of the pandemic. Last October, the company closed its $13 billion acquisition of E-Trade. That added the online broker's 5 million customer accounts, and it gave Morgan access to E-Trade's $56 billion in deposits. That's helping the bank fund loans to its wealthy clientele, substantially lowering Morgan Stanley's cost of doing business. Then, earlier this year, Morgan Stanley completed its $7 billion acquisition of Eaton Vance. That's added more fee-based revenues to the investment bank and lets Morgan oversee $5.4 trillion of client assets across its wealth management and investment management segments. Morgan Stanley presented its second quarter earnings on July 15th, and it was another in a series of successful quarters for the company. Morgan Stanley beat estimates on both earnings and revenues, had a 14% return on equity, and formally announced its spectacular dividend raise. E-Trade and Eaton Vance acquisitions provided immediate positive results. Wealth management revenues soared 30% year over year, and investment management revenues, they nearly doubled, while assets under management increased by a whopping 130%. Like all of the big banks, Morgan Stanley's earnings and revenues were hit hard by the Great Recession. Since then, earnings per share have improved dramatically. Sales have increased significantly too. Recessions and corrections can hit bank stocks quite hard, so it's important for investors to know their risk tolerance levels before investing in any stocks, especially those that can be as volatile as banks. I mean, ugly isn't a strong enough word to describe the chart on Morgan Stanley during the Great Recession. The company's stock price sank like a stone. I'm talking 75%. But in good times, banks can do extremely well. Over the last decade, Morgan Stanley has crushed the S&P 500 index. So, patient investors who can avoid panicking during recessions can do pretty well holding high-quality bank stocks long-term. If you bought Morgan Stanley 25 years ago, held it through today, and reinvested all the dividends, the position would have experienced a market-beating total return of 1,200%. And that's despite the 3 recessions that took place over that quarter century. So those are all the things you'll need to consider as you decide if Morgan Stanley or any stock is worthy of your consideration. Okay, let's take a quick look at valuation now. Most analysts who follow Morgan Stanley are bullish. Of the 16 analysts surveyed by TipRanks, 14 call the stock a buy, with an average 12-month target price that suggests a 9% upside. The analyst at CFRA calls Morgan Stanley a strong buy, values the stock at $102 a share. Value Line says Morgan Stanley is attractive long-term, with a 3 to 5 year target range that tops out at about 100% gain. Value Line also likes Morgan Stanley in the medium term, with an 18-month target price of $108. But Morningstar says cool your jets, bro. Even after praising Morgan Stanley and applauding the company's second quarter earnings report, Morningstar says the stock is worth only $70 a share, which would mean it's overvalued by about 32%. But I should point out that Morningstar has been at $70 for Morgan Stanley since early this year, meaning the analysts there have badly underestimated the stock's price potential so far in 2021. FastGraph says Morgan Stanley is pretty much fairly valued in relation to its performance the last decade or so. So we have analysts who think Morgan Stanley is undervalued, fairly valued, and overvalued. That emphasizes why we investors need to do our own evaluation to the best of our abilities with the facts that are available to us, and then make the best decisions for our own portfolio. Look, the next recession could be just around the corner, or it could be another decade away. Most likely, the truth sits somewhere in the middle of those. As a long-term investor with a diversified portfolio and a strong income stream, I'm happy to own a few bank stocks, especially when one of them is a high-quality operation that just doubled its dividend. Morgan Stanley works for me. That wraps things up for today. I'll be back in a week or two with another video about our next IBP buy. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our new content. Take it easy, everybody. Back at you soon.